day at the chart, a sea of red, talking puts and calls, but they just stare ahead. Strike price means nothing in their black minds. Margins and leverage like mountains to climb.
Mid-30s that can't stand up.
Spent the whole week
I can stand up. I can stand up while holding. Your dad's been trying to make fun of me, because I'm a fucking badass. Yeah, so it is what it is. I competed for 9 years in weightlifting. I was a nationally ranked strongman competitor, one of the strongest middleweights in the country.
Now he's just a heavyweight.
I still hold a national record for carrying 700 pounds, 100 feet in 22 seconds.
The only reason he was able to do that is because of 700 pounds of taco.
But I'm just curious, Abe. I'm gonna pick on you a little. Let me ask you this: how are you with your friends? Because I guarantee it's not as boring as you are when you're in here. Is it because it's your dad? Is your dad lame?
I mean,
Do you,
just different. I don't.
That's a nice way of saying yes. It's fine.
so let me ask you this:
You're not gonna.
Do you think YouTube is stupid? Is that where you're at mentally? Tell me what you think of all of this. Tell me what you think of all of this. What is your goal? What is your goal with what you're doing?
Make money.
Okay. Do you think the YouTube will make money?
I have no clue.
But what do you think? Tell me
Realistically,
what you actually think.
realistically, no. Only because the commitment part of actually keep doing it over and over again.
Why do you think you can't do that? If you do that with weightlifting, you do that with weightlifting, you don't even have a real goal for weightlifting. You don't think you could do this and it will actually make you money? I'm just curious where your head's at.
Well, not that it can't be consistent. It's that the tendon, out of past times we tried, it didn't go well. So based off the past attempts,
That's fair.
no. But
That's fair. We have tried this before.
to be fair, this
Didn't
time
go
a
well.
little.
But do you feel like you're actually
Different.
learning a little bit more this time?
Yeah.
Do you think that's because I just became a magical teacher, or do you think it's like you're a little bit more interested in trying to figure it out?
The interesting part. When we did it the first time, we said we were, but then we didn't even boot shop and not even really care. But
I feel like granted, you don't have the same enthusiasm that I would love for you to have. However, I've noticed a huge difference in the fact that not only are you giving it more attention, but you're also like, I can see you learning in real time. Like, granted, you're not getting all of the concepts because this isn't something that one can just go into and learn all the concepts. It's something that's going to take a few months before you can speak the lingo, before you can realize what you're doing, why you're doing it, and have an idea formed behind it. But for right now, we're just kind of going through the motions because the more and more we do that, the more questions you're going to have. And that's going to give me the opportunity to elaborate on some of the things. Like if we do something every day, eventually what do we get filled on? Eventually you're going to be like, all right, so why are we doing this every day? Like, I'm just kind of like trying to model how I would manage your account in real time with you, and then give you the opportunity to ask questions. So I guess I would just simply say, like, whenever there's something that you don't necessarily understand, don't be afraid to ask questions, because nobody that is looking at this knows what's going on either. You're not alone. This is something, what we're
But
doing.
you are alone. You're actually alone in a room with the lights off, looking very creepy, but that's besides the point, I guess.
But what I'm saying is nobody that's actually watching this has any idea. And the vast majority of money managers, people that get paid to do this professionally, can't do what we're doing right now, or don't do, because they're too scared, because it's too risky.
They're tiny PPs. Very tiny PPs.
I don't know. I'm very encouraged by how much effort you've put into it so far.
Yeah.
And I'm encouraged by the fact that I can see you becoming more familiar with not only the platform, but also kind of following along and giving me responses that makes me see that you're getting some of these concepts. Even if you don't know what you're getting it, you're still kind of like making good decisions just based on mimicking what you've seen so far. So that's the first step. And then, like, you don't have to build out all the math. All that will come later on. You can you can develop your own strategies after you learn the mechanics. But right now, we've basically just been going through a mechanical process of seeing how this market responds to our positions. And so far, it's actually responded pretty daggone well. Like if you look at your P&L and your portfolio, you're making good money.
I'd say also, Abe, that his concern about having to do this every day, quote unquote, I think that once he gets the basics and stuff down, that you don't necessarily have to trade every single day to be successful, right?
No, we're doing this. We're making videos 3 days a week. So effectively, I have them for about 40 minutes, 3 days a week.
But I'm talking about like in the future, like when he starts trading on his own, like doing his own thing, he doesn't really necessarily have to trade every day if he just didn't need to.
You don't have to, but I will tell you from someone that has substantial amount of money in the market, you will create by the nature of you having your own capital in the market, it will create a desire for you to be involved.
Yeah.
So you will want to
Be trading every day.
to be trading every day, be checking the market, seeing what's going on. You'll have a desire, you'll have a passion far more significant than you do now. So I guess let's look at our P&L for the day. Right now, we can see that today you were up on the day. What just happened? So this MP contract that we currently, all right, so hang on, go back to your regular platform, Abraham. We got to manage something. Go to MP. MP. You see that contract that's worth basically nothing now? 60 cents. The other one's worth $5. See that?
Mhm.
Go ahead and click on that, right click. What does it say? Create new order? Go ahead.
Create
Wait.
closing order. Wait.
Sure. Yeah.
Top
Create,
what one?
yeah. Create closing order. All right. Well, hang on. Not yet. You see how scroll up? Yep. Go to where there you go. It's on this expiration. You see how it's already got a bid in for, or it's already got basically an ask to buy that back. Now you're going to go ahead and sell something that's worth around $2 because you want $2 in premium to work against your $5 in premium to the other side. Maybe even $3. What's that?
I can a little bit.
So you see how you currently only have about 67 cents in the value of your current contract. You want to sell something closer to the money that has $2 to $3 in it. So the strike that you currently have is the 125. You're going to take it down.
Large.
Yeah, you're going to take it down to. Now let's see here. Maybe the 110, 100, 105. Take it to the 105. Hit control and hit the 105 bid. There you go. That gives you a credit of what? $1.55. Go ahead and put that through. Okay, hit send.
Is 35 still good? Is that 55? You said?
Yeah, it's fine. Confirm and send. You're adjusting your delta here. This is what we're doing. So the market's moving, the market's going down, which means your put is getting tested. So you see your put delta when you look at your actual delta on these two different contracts.
Yeah.
When you look at your put delta, your delta keeps going up in your put, and your delta in your call was basically nothing. So what we did is we brought the delta of the put or the call, I'm sorry, back into line. So like we're no longer taking as aggressive a stance in that one position. So we reduced our delta by about 50% by doing that. So that gives you some room. If this thing keeps going down, you're now going to make more money by that call. If it goes back up, then the call, yes, is going to lose, but you're also you have way more to move on the bounce than you do on the fall, if that makes sense, because you have $5.50 in the value of that short put. You see the short put? The 85 short put? That has $5 in it. That means that the most that you can make out of it is $5. Right? When we sold it, what was your trade price?
85.
What?
85.
No, your trade price. Go to trade price.
$2.84.
284. So now it's marking at 535. So it's basically it's 80% higher than what you sold it at. That's not good. When you sell things, you want to buy them back cheaper than what you sold them at. So it means it's getting tested. Now, when we originally sold to 125, I think we did that for like close to $2 as well. So that means we made $1.50 out of that $2 that we could make. And now by rolling it down, we're collecting another $1.40 or so. So we're just getting our deltas back into line. We don't want to be too long in this market. If this market keeps going down, we want our calls to continue to pay us. Because we're going to continue this episode. Abraham, open up all your equity positions. Every last one of them. Open them all up. We're going to go through them one by one. %90 of the time, this is what you're going to be doing with your positions. You put them on, you got 45 days. That is basically from the time you put them on, and then there's a management period where you're basically just kind of limiting losses for the next 45 days and adjusting based on that. So, all right, go to your very top one. You're up $35 overall, which is ACHR. Stock trading at $13. You currently, so these shares, I actually bought 10 more shares when this thing was down last night in the $11 range. I bought a couple of more shares just because I feel like if there's any risk in this stock, it's going to be the upside when it explodes higher. The call spread so far has paid you. When I say the call spread, you know what I'm talking about? Those two calls, yeah. Those two calls, you're short the 15, long the 20, right? How much value is left in that spread?
What? Which question?
How much value is left in that call spread?
Between the 13 and 20.
The 15 call and the 20 call, yeah. What's the difference in value between the 15 call and the 20 call?
5.
Where are you getting? Well, the difference in the strike price is 5. Yes, $500 in risk. That's your risk, not your value of the contracts. The difference in the contract is the difference in the price that they're currently trading at. So, what are they currently trading at, and what's the difference?
It's 0.56. Is the difference?
Where are you getting that from?
The trade price?
We're not.
What you said?
So the trade price is what we traded it at. The mark price is what it's currently trading at.
Okay. So it's like 0.21.
It's what?
Or 0.23 or 2.1, something like that.
$23. There's $23 left in this spread that you can possibly make. You broke up. What?
Where are you getting that?
The difference in the value of the mark prices.
Oh.
So one is marking.
Wouldn't it be
one is marking at 0.3.
Not 20.
One is marking at 31 cents. The other one is marking at 9 cents. Right? So the difference is 22 cents, 23 cents.
Yeah. That's what I said. 0.2.
All right, but that's all that you can make out of this particular contract. And so we sold it for, what's the difference in the mark price when we sold it? Or the trade price?
0.5.
0.5. So we've made 60% out of it so far, right? You could make 60 cents and now it's only worth 20 cents. So we've made 60% plus out of it. There's nothing left to squeeze out of that. So at this point, we have a decision to make. Do we want to close this or are we still bullish on this? Because at this
point, we've already made 60%.
Well, we would close one side of it, or what we can do is take on a little bit more risk in one direction. We've already bought 30 shares, right? So those 30 shares are going to help us if we get a bounce. And the 30 shares are at a price of what's the trade price of the 30 shares?
Trade price of the 30 shares?
Yeah.
Like when we bought them or currently?
The trade price, where we bought them.
We bought them at 13.62, like
13.6, right?
Yeah.
So we can do a number of different things. The biggest thing that we're trying to fix right now is the fact that there's not a lot of offsetting value in this call spread, right? So the call spread is only worth 20 cents. So that's only going to help us so much if this stock keeps going down. It's only going to offset. Remember, we have a put at 13, which is basically at the money, right? And it expires in 9 days. We sold the put for $1.10. It's now worth 90 cents. So the put is also losing value because we're getting closer and closer to expiration. The stock price is still relatively around the same price, even though it's gone down. But effectively, if the stock price continues to go down, we don't have much left to squeeze out of this call spread that we have sold against it. So you have two different options. You can effectively leave it the way that it is. You can adjust your call down to the next strike and collect more credit and take on more risk by doing that. So if we take our call from 15 to 14, we're going to get more credit. So go to your trade and look what that looks like. Go to trade. Type the ticker in there. ACHR. So if we buy back the call that's currently trading at like 30 cents or so, if we buy that back and go down to the next lower one, which is 14 or 14.50, go to the 14, we take it down $1, right? That collects us another what, 20 some cents, if that. No, you did it wrong. Yeah, you have two buys. You want to buy back the one and sell the other one. There you go. What does that give us? 20 cents? 21 cents? Yeah. So you're reducing the ability for the stock to move up by an entire $1, and you're only collecting 21 cents to do that. So I would do nothing in this particular example and give this strategy a little bit more time to work for you. It's already in the positive. So my personal thoughts would be just to do absolutely nothing and give it more time. You could buy a few more shares. You could sell some of your shares if you were in the positive, but you're not in the positive, so you don't want to sell your shares now. And you don't want to buy shares now. You're lagging out. You don't want to buy shares now because it's kind of in between. It's right in the middle. Like I bought shares because it was down in the $11 range when I bought my last shares in here, and it's since rallied back up. So like I feel like the best thing to do in this is nothing. All right, so go to the next one, AG. You remember when we originally put this on, we did I think the 11.50 and the 15. We rolled this put up $1 to $1.50 to the 13, collected another 30 cents, and guess what's happening now? It's still going higher.
I don't know, our internet. Why is the internet bug? Dad, are you lagging too, or is it just me?
No, I'm lagging every once in a while. Not as much as you, apparently.
I don't know. Something's wrong with the internet.
But right. Do you see where it's currently marking at? This 13 put is currently back at 25 cents, right?
Yeah.
Right. We sold it at 40. Mm-hmm. That was after we initially sold like the 11 and a half at 27 or 29, something like that. We bought it back when it had only like 10 cents left in it and rolled this put up already because the stock continued to go higher. If you look at where it is now, it's almost all the way up to our $15 strike, right? So my initial instinct would be to take this a little bit higher. You could leave it or you could take it higher. Either one of those would be acceptable. So basically buying the 13 and then selling the 14 on the put side, or just leave it and take on more short risk in metals. It's up to you. Go ahead and look at the option chain, type in AG in there, and then look and see what you can even get for rolling your put up $1.
What?
What's the difference in that price? We have basically a week left. If you go from your current price to the next price, what does that give you?
66.
So the new, hang on.
If we buy it back and so on.
Hang on, let me look here. The new contract's going to have a $66 value at the 55 to 66.
55, yeah.
So basically 60 cents. So you're going to go from having the 25-cent contract to a 60-cent contract. I would roll it given that information. Yep. $34 credit. Go ahead, send that through. All right. Go to the next one. AMD. All right. So AMD currently you're sitting at how much in profits? Go to year to date. You're at $207 in profits. Here's what I would tell you to do with this. Go ahead and click all of your contracts. Can you control click all of them?
What?
Or shift click all of them or control click all of them? There you go. Right click and say close. And then does it give you an option to close everything? Actually, here, let's go to the fundamentals. Go to trade. Go up to trade. Type in AMD. Then minimize this. Minimize the chain.
I don't think it.
No, you're right. Minimize the chain. Minimize that. Now go to the one where you have the contract. And basically, in order to close these out, you have to take the other side of the position. So if we sold something, it means you have to buy it. Right. So if it's red, that means you got to buy it. If it's green that means you have to sell it. Yep. Just do the opposite. Yep. Perfect. Now it's saying that you can buy this back for $3.44 currently. So if we're currently up, is that what it says? 344, 340?
Yeah, 345.
So if we sold it for, I think, around $5 and some change, and we're trying to make $2.50 out of it, the midway price, put in there $3. My video's not sharing anymore.
Oh.
You got $3 in there? Close to it? All right. So then
$3.
now take your time and force. There should be a metric that says TIF or TF. See where it says
TIF,
day?
Yeah.
Is there one that, yep. Go ahead and just put that in. So that means the next time that it gets to that point, it's going to go ahead and fill.
Sell it?
Yep.
Oh. So I just got to confirm the sum?
Yep. There you go. So now you have a working order in that's going to close that at the next point where you're basically up $250. All right. We've done AG. We've done AMD. Let's look at Angel Studios. I don't think we have to do anything in there. That's more of a longer term position. So we'll go ahead and close that one. Let's do APLD.
Why?
I think I bought you shares in this, didn't I?
Mm-hmm.
You have 50 in there, don't you? Yeah. So those 50 shares have made you $23. The puts.
How do you see that?
Look at your open P&L.
I'm looking at it. It says 252.
Open P&L on your 20 shares or your 50 shares is 25, 24, 26. Your shares. Just the shares, not the contracts. The shares are one up. That's your shares. Look over on the left hand side. You see where it says
this one.
No, you see where it says plus 50? That's your 50 shares.
Yeah.
Right.
I didn't realize that.
So it's telling you that the shares so far have made you anywhere from $25 to $28, depending on what the stock's doing at this given second. The contract, the call contract, because this thing has rallied straight up, has basically lost you $250. So you sold it at $1.81. It's now marking at $4, right? But we bought the shares, so that's going to cut the negative impact of that call by 50%. So this one, again, I would probably leave alone, which means you're agreeing to buy another 100 shares at $27. You're a little bit longer in this position than you were initially because of the shares. However, I kind of like the premium that you're getting, this $4.32 in premium on that call, which is still $6 out of the money or $5.50 out of the money. I like that because especially now that you have the shares, if this thing continues to rally, it's going to ultimately be a good position for you because you're long overall 19 delta. Look at your delta. Look at your overall delta. So you see how that 50 delta that you get from the shares, that is constant. It never changes. Whereas the other delta from your option contracts are changing in real time.
Lisa.
Yeah.
Changing it. It's
Those are your
constant.
options. Those are dynamic delta. Your shares are static delta, which means they will always be 50 delta. It doesn't matter how high the stock price goes. It doesn't matter how low it goes. They're always going to behave as if they're 50 delta because it's a static delta. That's the difference between an option contract when it comes to your delta and a share when it comes to your delta. They behave differently. So I kind of like this right here. I don't think I would do anything with that. I think I would just let this go. And hopefully the stock price doesn't go all the way to 43 and we can collect over the next course of the 37 days. We can collect some of that $430 in premium decay. All right. Webull. This one we put on a couple of days ago. And effectively, it really hasn't moved at all. It's still, it's at $0. So I say we leave it. It hasn't moved a penny. Wait. Now I'm seeing $18. Did it move? Oh, it's up 19 bucks. I misread that. But there's still 40 bucks out of it. So we collected $60 credit to begin with, and we still have another $40 to go. I would leave that. Actually, for Bull, go ahead. This is another one that you can put in a good till cancel order or good till close or cancel. Go ahead and put an order in to close that. Click on both of the
ticker.
Well, go. All right. So go back to your monitor tab.
Oh.
And you can do it in your monitor tab. Just hold down Shift. Click on both of them, then hit create closing order.
Yeah.
And then you're going to buy the vertical. Right? So now you see it pre-filled those options for you. And now you see where it says there's $40 left to collect. We initially sold it for 60. So mark it down to 30 or 29 and then go from day to good to cancel and go ahead and send that through. So that means once you've made 50% out of that contract, it's automatically going to pull it off, take it off your risk. MP is another one here. MP is getting destroyed today because, all right, so MP is the one that you already adjusted when it was down at $87. Now it's rallied back to $89. And however, you're just losing more and more because the volatility has basically told the market that it's not sure which way it's going to go. So they're just pricing in risk to either direction. I kind of like where you're sitting in there, so I wouldn't touch that again. You have $8.40 left in that in those contracts to make. So I just leave that one alone. Oklo. So this is the one where you can say thank you for my $240 because I sold these earlier today because the stock was way overpriced. And I just did that on your behalf. You're welcome for the free money. PAL, P-A-L-L. I say you don't touch this. I say you just keep letting it go until the end of the week, and then we decide on Friday what to do with it because it's a covered call. So, like, if the stock is over 140 on Friday, then we have to do something. If it's not, then we just sell another call. And you get to keep that $170, and then we sell another one for next month. All right. What else we got? QuantumScape. All right. So this is an earnings play coming into the end of this week. Remember, we did this where we basically paid $250 to make it, to have a straddle. But look at how much money we've made so far. $37, right? In 1 day, or 2 days rather, we made effectively 10% on our money. If we paid $250 and we made 30,
Be fine with that.
Oh, she would.
Yeah.
if we paid $250 for this strategy and we made $37 in 2 days, we're over 10% of our profit with it that we could potentially make. So this is a candidate to potentially close out and take your profits. So you could either choose to leave this on, hoping for a big move on earnings, or you could just close this out right here and take your profits and walk away. You already made 40. Yeah, I agree. You should take it off. So you click on all of them, hold down control, click on every last one of them. Go ahead and hit
That one.
right click. Yep, right click. Close. And there should be one that says double diagonal.
Diagonal. Is it DBL diagonal?
Hit double diagonal, yes. Go ahead and do that. Go ahead and
Diagonal
send it
only.
through. What is it marking at?
Marking at 292.
292. Yeah. So you're gonna sell it for 292. You bought it for 240 something. So yeah, great.
First time.
There you go. You just made $40 in 2 days on $250 risk. So that effectively is like making 20% in 2 days. All right, go to Reddit. This one, honestly, I just leave it. This thing hasn't moved in like a week and a half. It's basically been somewhere around 197 to 205. If anything, you know what? Go ahead and put a good to cancel order in here too. Do it at 50% of what you paid for or sold it for.
Yeah, we sold it. Yeah. Okay.
Well, you got to see what you sold it for to know what to put it in at 50% of the closing price. Go back to your monitor tab. What'd you sell it for?
The 125.
120 or 225?
$2 at the 125.
Okay, well the strike is irrelevant.
Oh.
If you sold it for $2.02, that means you buying it back for $1.01 or $1 basically.
Mhm.
So go ahead and change your 171, which it's currently marking at. Change that to $1. Okay, and then hit good till change from day till good to cancel, and then go ahead and send it through. So what this will do is it'll allow, so like if Reddit rallies on the opening tomorrow and gets to that point where it gets down to $1 and then sells back off, you're not going to miss it now. You're going to get filled, take your profits, and walk away. Maybe we'll sell it again 2 days from now at the same price at 170. But this way, especially if you're not looking at these things every day, all day as the market goes, then these good till cancel orders will make sure that you don't miss your take profits. All right. You got Reddit. Snap. Snap is basically still a loser. How much are you down on Snap?
70 cents.
You're down like $40. 30, 35, $36. Look at your overall P&L in Snap for open. $37. You're down. I would just leave that. I wouldn't touch it. If anything, if anything, if you wanted to buy a little bit more Snap here and sell the same call again, you could do that just to kind of average in. But I would wait till if it gets lower, like around the 750, 725 range, then I might buy a little bit more. But for right now, I'd probably just leave that with the idea that if the stock goes lower, I would pick up some more shares. And then now you've got your Russell. Overall P&L for the day, and your Russell is negative
113.
negative $10.
Oh, that's what that is.
Negative 15 right now. Yeah. So you should open up your Russell and look at that, because I've done a lot of adjusting in the Russell. We went from basically having a 10-day contract, but it rallied basically 75 points in the last day and a half. So what I was forced to do was take that 10-day contract out in time.
Even have days in there.
Huh? Hang on. No, what?
We can have days in here. You didn't show how many days. Like up
Oh.
here.
Gotcha. Days. March. Oh, I don't have it in mine either. Let me add it to mine. So we're looking at the same thing. All right. So basically, you can see now you have 37 days left on both of those contracts that are still active. But what I gave up for getting into that was the fact that there was over $1,000 that was going to be expiring within the next 10 days at 2,500. So I gave that up, collected a bunch more in credit, and you can see that we have an overall, if you look at your overall delta in here, is it positive or negative? Do you have delta on there?
Yeah, it's 18.
18. So you're positive 18 delta right now.
Mhm.
18 SPY delta, beta weighted SPY delta. So basically being long 18 shares of a $600 product, which is like $2,000 worth of positive leaning exposure in the market. It was negative, but in a day and a half with the rally, you basically went from being short to long to now you went back to being short because like I adjusted this position probably like 4 times yesterday just to try to keep your delta relatively neutral and collect more premium. And eventually it got to the point where it was basically went from a strangle where we're selling out of the money, and then I had to adjust it so much that we got closer and closer and closer to the money. So then what I did is I basically widened it back out with more time. So I exchanged the value of the contract for time value further out in the future and still took in a credit. So your overall credit in here now, I think the contracts are worth like something like $4,000. Like that's the amount of total value that has the potential to come out of these contracts in the next 37 days. So there's a good buffer to the upside, to the downside. I wouldn't do anything with this. I would just sit here and let this go. Ideally, unless we had a crazy move, you're going to be able to let this go for the next week or two and then kind of check back in. And that's basically it. That's all of your positions. I think you still have like 20 grand. If you wanted to do another position, we can look at it, go to your scan tool. We can look and see what's going on today. Take your 50 back to 2,000. Oh, it's already there. Sort them by IV percentile. Okay. So then in your IV percentile here, what are you getting on your list? My list looks different than yours.
I don't know.
Okay. Hang on. What's your top one in your IV percentile? 100?
Grind.
100? Yeah. All right. We got the same ones. So let's go. So within that list, what's the one that is basically giving you the most volume? There's one that's up 15%, right? You see 113 million shares traded,
Oh, yeah.
right? Let's click on that and see what's going on in there because that's not normal. Let's go to trade. It's NVTS. So let's see what we got here. All right, NVTS. So right off the bat, you see where those yellow expirations come in here? You see how you have yellow expirations? That means that there are weekly options, which usually is an indicator that there's good liquidity in there, which means it's more likely that we're going to trade something like this. If those yellow ones were not there, you would be left with the 2-day, the 37-day, and the 65-day. That usually points towards a lack of liquidity. So this is a good sign right off the bat that we have those expirations. So you're looking at the 23-day, okay? Holy crap! What is this stock? Before we go any further, what is the stock's name? What does it do? Is it a biotech or something? I like to stay away from biotech. NVTS. It's a semiconductor stock. All right. Cool. All right. So let's just do. All right. This is a new strategy that you've never seen before. Let's do a iron fly, basically. So we're going to sell the at the monies. Premium is so juicy in here. We're going to control click and sell the put at the money. Yep. and sell the call at the money. So effectively, you can choose to sell the 14 or the 15. It's up to you. I'd probably do the 15. Both sides. You're going to sell both sides. All right. And then go $5 to $10 out of the money. So on the put side, go to the 7 strike and buy that. Yep. And then on the call side, we're going from 15 to we'll just do the 24. That's as far as you can go. $10 basically. Right. So that gives you what as far as a credit?
4.77.
All right. So go ahead and hit confirm and send. And what does that tell you as far as your break evens now? It should give you what your break evens are.
Break even is 10.23 and 19.77.
So you're creating a trade that over the next 23 days is going to make you money if the stock is under $20 and over $10. It's currently trading at basically $14.50. I like that. Go ahead and send it through. Your most risk, you might have to adjust it a little bit. Your most risk that you're taking is to the upside, which means if it goes up higher than
has a name.
It's an iron condor. Yeah.
Actually, I thought that it's just like things that people call it. Like,
no, it's the name of the strategy. Right click on it and adjust it. It's an iron condor because it has 2 long legs out of the money and 2 short legs.
Well, yeah, I get the name. I just thought it was just something traders used as a way to describe a certain way to do it.
It is something that traders use, but traders also built this software. So they built it into the software.
Okay.
Go ahead and mark it down to like 474 or 473. Still not filled. Go put it down to 47. There you go. You got filled. All right. Yeah, I mean, the people that built this software are people that traded these strategies for a very long period of time. And then eventually they realized everything was going digital. So they decided to create software to facilitate trading. But they're traders that built the software.
They make money off this app?
Yeah, they sold it for like $1 billion. Yeah, they made money off the app. I think it was a little, I don't remember the exact amount when they initially sold it. Yeah, they sold it to, so this software, I think
Can't you see the candles rise and fall? Risk and reward, it's a game of all or no. Options open, futures closed, eyes blind. Frustrated fathers dream in the stock grind. Explaining specs, faces blank as empty streets. Hedging positions, but the questions repeat. Time decay means nothing to the young souls in this market. Play is like digging holes. Iron condor flies, but it never lands. They can't grasp the feel of these trade winds. Liquidity try choking on the sand. Profits and losses, they'd rather go play bands. Candles rise and fall. Risk and reward, it's a game of all or no. Options open, futures closed.